Welcome back to the Deep Dive. If you've peeked at your portfolio lately, you know the turbulence hitting the crypto market is just extreme.
It really is.
Bitcoin took a significant dive, which is painful enough, but the real alarm bells, the ones signaling some fundamental market stress, they're ringing for absolutely everything else.
That's the critical distinction. We are well beyond a standard correction here.
Right.
Our mission today is to look past just the price drop and unpack the three major forces converging right now. The deep technical breakdown of Bitcoin, the unprecedented structural stress from new things like ETFs, and the really complex geopolitical backdrop that is making global markets incredibly nervous.
We need to understand the deeper stress points.
Exactly, the whole ecosystem.
Okay, let's get straight to the numbers, because they tell the story of the pain you're probably feeling. Bitcoin has plunged a brutal 22 to 23%.
Right, from its recent peak of $126,000.
That's bad. But if you hold anything that's not Bitcoin, this next statistic is the one that really matters. A staggering 95% of the top 500 altcoins are currently red.
And that's what analysts call the altcoin alarm. That 95% number, it means the median altcoin's profit supply is deep in what they term the historical capitulation zone.
Which is just technical language for what?
It's technical language for most people who bought recently are underwater, and sentiment is terrible. If you want proof, the fear and greed index is pegged at extreme fear.
That's the number.
It's just 18. This is a genuinely defensive, fearful market.
Okay, let's unpack the technical forces driving this, starting with Bitcoin. It's not just that we lost the big, round psychological number of $100,000.
No, the charts confirm the reversal is serious.
How so?
Well, losing the $100,000 mark was mainly psychological, but the technical breach was actually more important. Bitcoin slipped below the 0.50 Fibonacci level.
Near $99,600.
Exactly. And for the non-traders listening, you can just think of those Fibonacci levels as like critical lines of defense based on the prior rally.
Yeah.
Losing that 0.50 line means the market is confirming that the sellers are now firmly in control, at least for the medium-term trend.
And what's interesting here is that analysts are pointing to a major reversal pattern that guided this whole move, the shoulder over shoulder or OBO pattern.
Yes, the one that peaked near $124,000.
For our listeners who aren't charting this stuff all day, what does that pattern actually signify when it completes?
It's a classic reversal signal. You picture three peaks, a left shoulder, a higher head, and then a right shoulder.
Right.
Once the price drops below the neckline connecting those valleys, which was around $105,000, it confirms a major trend reversal is underway.
So it tells you the high is probably in.
It's a very strong signal that the high is in and the market is moving into a prolonged downtrend. And the fact that the price retested that zone and was immediately rejected, that just confirms the downside risk is still fully in play.
So if the previous key levels are now resistance, where are the big buyers waiting? Where should we be watching for a new floor to form?
The immediate technical focus, it shifts to the next strong line of defense. That sits around $93,600 to $93,700.
Okay, that's the 0.618 fib.
That's the 0.618 fib retracement. It's the last major support line before things could get really precarious.
And if that fails?
If that band fails, the critical target aligned with that whole OBO pattern is the $85,000 to $86,000 region. That is the point where the structure suggests meaningful long-term buyers might finally step in.
If the charts look bad, the money moving behind the scenes, the on-chain data, is actually, far more alarming than just the price action.
It really is.
We have to talk about the supply flood. This isn't just retail panic, is it?
No, and this is the most fundamental shift we've seen. This is not day traders getting liquidated. We are seeing long-term holders.
The diamond hands.
The so-called diamond hands who survived 2018 and 2022. They're releasing a staggering 815,000 DTC back into the market.
In just the last 30 days.
In the last 30 days.
Wait a minute. These are supposed to be the most confident investors. Why now? Why are the people who held through every major bear market suddenly gumping?
That's the multi-million-dollar question, isn't it? This is the largest wave of distribution from older supplies since January 2024.
So what does that suggest?
It suggests a deep psychological fatigue, or maybe a belief that the current macro environment simply doesn't support higher prices right now. The implication is severe. A surge of old, dormant supply is entering a market that just cannot absorb it.
Creating that constant selling pressure.
Aggressive, constant pressure.
That leads us straight into the new structural vulnerability of this market. And ironically, it was supposed to be its strength. Institutional money. the ETFs.
Right, the core paradox of this market cycle.
We saw $59 billion poured into U.S. spot Bitcoin ETFs since the start of 2024. That money was meant to stabilize things.
But it's actually becoming a massive liquidity trigger. This huge pool of capital carries a critical stress point that everyone is now laser focused on.
And that is the average purchase cost.
The average purchase cost of all that institutional Bitcoin. And that number is pegged at $90,146.
That is the line in the sand. Explain why that specific number is so terrifying to people.
It's terrifying because institutional selling is different from retail selling. Right now, unrealized ETF profits have already collapsed from a peak of nearly $24 billion down to just under $3 billion.
They're barely in profit.
Barely. So if Bitcoin breaks decisively below that $90,000 threshold, those massive funds go underwater. They switch from managing profits to managing losses.
And they might be forced to sell.
Many may be forced to initiate large-scale selling of actual Bitcoin, either to manage risk or just respond to client redemptions.
That's a potential supply cascade. We saw the immediate fear with that sharp single-session outflow, almost $870 million from the ETFs.
Exactly, proving that institutional conviction is pretty fragile right now, and that fragility, it translates directly into liquidations in the derivatives markets.
We saw $2.3 billion erased recently.
A staggering amount. When you see that much capital vaporize, you realize this isn't about percentage drops, it's about leveraged traders, both retail and professional, getting entirely wiped out in minutes.
And the data confirms how widespread the pain is. Nearly 99% of all Bitcoin acquired in the last 155 days is currently in a losing position.
It confirms this isn't a localized dip, it's a comprehensive washout. And we can't ignore the outsized influence of strategic short selling, often by whales.
Right.
We had reports that one major player reportedly earned $200 million by shorting both BTC and ETH during that big October 2025 event. So they're amplifying the moves.
That brings us perfectly to the third dimension of stress: macro and geopolitical headwinds. Bitcoin, despite all the claims of decoupling, is acting like a high beta tech proxy.
Precisely. It's tracking what the stock market does, especially the NASDAQ. It's reacting to global liquidity tightening and broader macro uncertainty.
So the idea that pro-crypto policies in one country can save it is not holding up.
That narrative has been thoroughly tested and found wanting. Macro conditions are undeniably amplifying the current decline.
And the trigger for that major market volatility back in October 2025, it wasn't even crypto specific, was it?
Not at all. It was pure global politics. The crash, which saw over $19 billion liquidated in 24 hours, was partly driven by a geopolitical shock.
Which was?
The key catalyst was the U.S. president announcing a massive 100% tariff on Chinese imports, instantly reigniting the trade war. Global markets reeled, and crypto followed almost immediately.
This feeds right into the strategic geopolitical battle for financial leadership. The U.S.-China digital asset dispute. Their approaches are just fundamentally opposed.
Completely opposed. On the U.S. side, the stance is aggressively pro-blockchain, but explicitly anti-CBDC. Measures like the Clarity Act are designed to reinforce the U.S. dollar's dominance by, legally prohibiting the U.S. central bank from issuing its own digital currency.
The idea being the dollar is strong enough on its own.
Right, while China is pursuing the exact opposite strategy.
Tell us about that.
China is aggressively advancing its digital yuan, the ECNY, as a strategic tool to reduce reliance on the U.S. dollar and the whole SWIFT system. They are rapidly expanding cross-border trials, like the mBridge project with Hong Kong and the UAE. It's a strategic move to reshape global payments and challenge dollar hegemony.
So with all that uncertainty, how are institutional portfolios trying to hedge against this?
They're adopting increasingly sophisticated strategies. We've seen them use complex delta-neutral approaches, basically combining Bitcoin exposure with quantitative risk management to try and get returns without taking directional risk.
No.
But there's another fascinating point here. Research indicates that institutional players are increasingly viewing Ethereum as a preferred safe haven against geopolitical crises.
Now that's a crucial insight. Why Ethereum over Bitcoin in that specific hedging role?
The analysis suggests that because of Ethereum's programmable nature, its utility, and the depth of its decentralized apps, it makes it more resilient to the localized shocks of geopolitical maneuvering.
More so than Bitcoin.
More so than Bitcoin, which is still primarily viewed as just a high beta store of value. And of course, gold retains its traditional role as the ultimate safe haven.
That massive takeaway Ethereum, viewed as a better geopolitical hedge than Bitcoin, is definitely something for you to think about. Let's move on and discuss resilience, because the extreme volatility in October proved one thing. The infrastructure was not ready.
The crash exposed profound systemic vulnerabilities, particularly in centralized exchanges, or CEXs. A devastating 71% of liquidations happened on those platforms.
And they had outages.
They faced serious technical outages that left traders completely unable to manage their positions. Worse, it exposed major transparency issues under extreme stress.
And we saw systemic risk leak out into the core of the market. We saw the severe depegging of the stablecoin USD. It went down to, what, 65 cents?
It did. And that was a moment when the market realized the foundational layer stability was at risk. The USD depegging wasn't just a pricing flaw, it was a systemic risk indicator that these mechanisms can fail dramatically under stress.
But there was a divergence, wasn't there?
A stark, fascinating divergence in performance. Decentralized exchanges, or DEXs, specifically Hyperliquid, showed genuine crucial resilience.
How significant was that difference?
It was massive. The DAIKI-X maintained 100% uptime and completely avoided bad debt while the CEXs were faltering. It's a single data point, but it highlights the profound potential of decentralized infrastructure.
To mitigate the exact risks CEXs are susceptible to.
Exactly.
That success story offers a blueprint for operational strategies. What are the sources recommending for businesses and traders to navigate this?
For Web3 startups, operational continuity is everything. They are moving to use automated crypto to fiat conversion platforms.
What does that do for them?
It allows them to lock in favorable exchange rates and ensure stable fiat coverage for things like payroll and rent. It insulates their operations from these huge dips.
And for general traders?
For traders, the advice is simple but vital.
Yeah.
Always use stop-loss orders, maintain diversification, and don't try to fight a market that is signaling extreme fear.
So what have we synthesized for you today? We started by acknowledging the extreme turbulence, and what we found is that this is so much more than a standard dip.
This is a structural correction. It's driven by an unprecedented wave of long-term supply being released, and it's amplified by the vulnerability of these new institutional entry points.
The Achilles heel right now.
The Achilles heel is the ETF average cost basis near $90,146. The market will likely remain leaning heavily bearish until we can reclaim technical structure convincingly above $100,000.
As we end this deep dive, the extreme volatility has forced everyone to seriously question the reliability of the centralized infrastructure they use.
It has. The October crisis proved the unreliability of CEXs, outages, stablecoin depegging. It was a mess.
While the resilience of DEXs was undeniable.
The resilience was undeniable. And this raises a profound question for the future of stability in crypto. Will the path forward require less reliance on centralized platforms that failed under pressure and a necessary strategic shift toward decentralized risk management infrastructure?
The market is currently voting on that question with its feet and its capital.
It is. It's the divergence we all need to watch.
We'll catch you on the next deep dive.